Where we are in the AREIT cycle, I'd first start with where we are in the direct property market cycle. And what I mean by that is where the physical real estate is transacting in the market. We're now really moving to 10 years out of the GFC. So we're a very advanced stage, I'd say, of the direct property cycle. If we move to the AREITs and where they're trading, if you had a look at where assets are actually transacting in the direct market, AREITs are actually representing pretty good value to the transactional market. Then if you dig down further into the AREIT sector, you'll find areas on our analysis that look relatively expensive, and you'll find other parts of the AREIT sector that represent really meaningful value, and that's where our interest lies. Well, in looking at how they've performed so well in the last 7 years, you've got to really look at where AREITs have come from. 2008, 2009, we had the GFC, and of course AREITs were severely impacted. They over-levered and they fell heavily. Just post that, they recapitalised, their balance sheets in great shape, but because of where they came from, they were very much an unloved sector, trading at a meaningful discount, with strong balance sheets and good cash flow yields. That, if you like, provided the framework for the solid performance that we've seen, over the last 7 years. Well, in our investment framework, what we do is we take a through the cycle valuation approach. So by doing that, we adjust up what we call capitalisation rates, or think of investment yields, to where we think they should settle over a long period of time. In doing that adjustment, we don't see a lot of value in East Coast office properties at the moment, so we're not seeing value there. We are seeing value and we are attracted to the retail property sector, particularly the top tier malls and the convenience ones. We see really good value there at the moment. Why are we seeing value? Because other people are worried and concerned about that space, because sales are fairly modest. We've got fairly weak wages growth at the moment. We think that will improve in time. But also, importantly, they're worried about e-commerce and Amazon in particular, and we think those fears are overplayed in that subsector. We really like retail property. The reason why we like retail property is if you think about retail property, large footprints of land in inner urban locations that adapt and evolve and move over time. So if you're thinking about disruption, retail is a great subsector because it actually adapts and evolves over time. We're finding that they're introducing more food, leisure into their centres, building an office, building hotels, building residential. You're starting with a big footprint of land you can adapt and evolve over time. The last subsector is industrial. We're not seeing great value in the industrial subsector at the moment. We don't like being right out on the fringes in industrial. We like being more in that infill location where you can ride to a higher and better use. But in saying that, we think retail represents a better opportunity for capturing that at the moment. Well, with looking at the residential property market, we all have a deep fascination with that market. We've all got exposure to that market, and we tend to look at where we live as a barometer of what's going on in the market. But it's a lot broader and it's a lot more complex than that. Firstly, if we look at the underpinnings of the market, population growth, solid. Supply of housing, fine. Not an oversupply of housing. That's positive. The negative, definitely credit rationing. That has been tightening, and it's been tightening for the last 3 years, and the Royal Commission is the further extension of that, if you like. So how we're seeing that play out, what we're seeing is we're seeing the established investor market clearly softening, weakening. We're seeing the owner-occupier in the established market weakening to a lesser extent. We're seeing clearance rates across the markets in the 50s, certainly in Sydney and Melbourne. So it's tough. But then if we move across and we have a look at the key growth corridors, land, what I mean by land, house and land, that's going really well. We're seeing price growth actually in those price corridors still. And if you looked at Melbourne, for example, days on the market, they've absolutely collapsed. The days on the market to sell a lot is at its lowest levels for a long time. So that's the clearance rate there. So that's really strong. So in wrapping it up, residential, it's very broad. It is very complex, but the underpinnings of population growth are solid, and we still think that house and land will do well, and that's why we like to have exposure to the developers which capture that.